Good morning, and thank you for joining Town Benefits webinar on the Patient-Centered Outcome Research Institute, also known as the PCORI fees. And those fees will be paid in 2026 for plan years that ended in 2025. I am Corbin Granger. I work in compliance at Town Benefits, and thank you again for attending. Now, if you've ever heard one of our presentations before, you know that I am not a lawyer, I am not a CPA, and I'm basing the information that we get from the IRS, Department of Labor, Health and Human Services, or even legislative changes. So this is supposed to be informational. So if you have a very specific tax or legal question, I would suggest you reach out to those specialists. What is the PCORI fee? The PCORI fee is an annual excise tax. It applies to fully insured plans and plan sponsors of self-funded health plans. And so you are listening to this webinar today because you have a self-funded health plan. So what does that mean? Employers must file Form 720 if the plan was self-funded, level funded, balance funded, and ended in 2025. There are a number of ways to discuss self-insured plans. Now, if the employer has a health reimbursement arrangement that ended in 2025, there must be filing for that HRA as well. The last two are the Qualified Small Employer Health Reimbursement Arrangement, you know as QSEHRA, or an individual health reimbursement arrangement that ended in 2025. So how are the PCORI fees calculated? The total PCORI fee is based upon the term average number of covered lives. You get the average number of covered lives, and then you multiply it by the PCORI fee that applies for your year. So every year in October, the IRS changes or adjusts the PCORI fee. So for example, if you have a plan year ending before October 1st of 2025, the cost is going to be $3.47 per covered life. If your plan ends in October, November, and December, it will be $3.84 per covered life. So how do we calculate the average number of covered lives? There are three methods to do that. The first is you're actually going to count every single employee, spouse, and dependent who was covered on every day of the plan year. So as you notice, that might be somewhat cumbersome because the number of employees, number of dependents, that's going to change throughout the year. So having to go back and do that actual count is probably not the best way to do it. The second method is what we call the snapshot method. And there are two snapshot methods. There's the snapshot count, which I'm talking about now, and the snapshot factor, which is on the next slide. So the snapshot count is exactly what it sounds like, meaning you're not looking every single day, but you're taking a snapshot in time, either the first month of each quarter, the second month of each quarter, the third month of each quarter. You pair that up, those quarters, with your plan year, and that's how you count. So you would be counting the actual covered lives on at least one day per quarter. And then you divide it by the number of days used. That's usually 4. So depending on when your plan year started or ended, you will be able to fit into one of these quarters. The next one is the snapshot factor method. It's the same premise. You're getting a snapshot in time in either the first month, the second month, or the third month of each quarter. But instead of calculating every single person covered on those quarters, you're going to take the number of participants with self-only coverage, and you're going to add it with the number of participants with dependent coverage multiplied by 2.35. So let me say it again. You're going to take the participants who have self-only coverage, those who have dependent coverage, you're going to multiply by 2.35. This is usually a pretty good way to use for the Form 720, simply because if your carrier sends you bills that have the tiers of coverage, that will be a good option. Last method is the Form 5500 method. Now, Form 5500s only apply to plans that had 100 or more participants in the plan year, and it has to be filed without any extension. There is a special rule for counting health reimbursement arrangements. So, health reimbursement arrangements are considered self-insured plans, so they are subject to the fee. Now, if you have an HRA and your coverage is fully insured for your company, you will only file Form 720 for the HRA because the carrier will file it for the fully insured coverage. You do not count dependents, spouses. You're going to use just the one life per participant rule. So if you have 10 employees with the HRA, that's going to be your count. You don't have to think about spouses or dependents. Now, an HRA with self-insured coverage works a little differently because the self-insured plan is subject to the fee. So if you have a self-insured plan with an HRA, you're actually not going to count the HRA. You're going to do it based on the self-insured plan. That way you're not billed twice. So this is also included with a standalone HRA, a Qualified Small Employer HRA, QSEHRA, and individual coverage HRA, ICHRA. And again, you just count the lives of the employees within that plan year of who was covered. You do not count any dependents or spouses. So how do you complete Form 720? It's actually relatively simple. It's just that it's a form that really doesn't work well with reporting certain fees. So the Form 720, it's an 8-page quarterly excise tax return, but you're only going to be filling it in one part of the tax form, and only for the second quarter of the year. So page 1 has taxpayer information, page 2 has PCORI fees section, page 3 calculate the final task, and then you get the payment voucher. And I'm going to be going through all of that. So you can see this is the Form 720. They revised it in June of this year. It came out a little late, but at least we have it. So under the first part, you're going to put the name of the company, and you're also going to list June 30th, 2026. If you put in 2025, it's going to think that you are behind in your paying of the PCORI fees, and we don't want that. So here you go. This is page 2, Form 720. There are 8 pages in this form, and you're really just going to look at a couple of pieces. So you see in red the section that says 133, applicable self-insured health plans. Here, it's a health plan year that ended before October 2025. So let's say you had a plan year that ended in July of 2025, then your fee is going to be $3.74 per average covered life. Now, with D, if you have a plan year that ended on or after October, November, December for this filing, you're going to use the larger $3.84 per covered life. Under Part 3, you're just going to take the tax and move it down, and you really shouldn't have to be reporting anything for any prior year related to this. So when you get to the balance due, you put the balance due in line 10, and whoever is going to sign for it, you put their information there as well. Last is the payment voucher. So you're going to enter the amount of the payment, and you want to indicate it's for the second quarter, because you only file this annually in the second quarter of the year. You can mail it into the IRS or use the electronic tax payment system if you have that system. So where to file? It's on page 2 of the instructions. You send it to the Department of Treasury, Internal Revenue Service, Ogden, Utah, 84201-0009. And again, you can file it electronically if you have access to electronic filing. So this really concludes my presentation today. And again, we always encourage you to review with your CPA or tax specialist information related to the PCORI fee filing. We have HR on Mike here at Town Benefits. It's a little show on Spotify that comes over with little compliance and HR questions that Barbara and I see. So if you would like to listen to it, please go to Spotify. Thank you for attending.